This was really the starting question that I struggle with every day, and it's why I'm not in the Bahamas yet, because I haven't quite got there. I'm only 32 years down my journey. Some of you will be 50 years plus down your journey, so apologies if I haven't caught up with you lot yet. But all I can say is this is as far as I've got so far in how to make money in the market. And as I've only got 20 minutes, I'll cut to the chase. Basically, I think it boils down to picking stocks, which sounds like a ridiculously easy thing to say, but I do believe the market is full of so much waffle relative to the job at hand, which is basically to make money. And it does stagger me that I write for hours a day, even about the market, and that I am constantly called on in the media to comment on the market. But the truth of the matter is the market discussion rarely really makes you any money. And I also think that people who are talking the market are really missing the point of what makes you money. And what makes you money is what stock you hold, whether it's going up in price over what time scale, and not what the market is doing as a whole. So the whole thing about the market for me boils down to, and we try and do this in the newsletter, boils down to basically picking stocks. And of course, Skaffold is an instrument designed to help you do that, which is why I'm a founding member and love the product. There you go. Why do you have to pick stocks? There are a few points here. You can't trust the market to go up. Now, this might seem a weird thing to say. The market's gone up 5.76% for the last 75 years, since my dad was born. But if you look at this, you'll see why it's done that. This is the All Ordinaries Index, showing if the 33 years prior to 2007, it went up 11.7% per annum. That something happened around 1974, because prior to that, for 33 years, it went up 2.9% per annum. And if you take off inflation, which although the government will tell you it's 2.8% or something, the truth is instead it has been over 4% since 1940. And if you take that off the 2.9%, basically in the stock market, you go backwards. And this is why except for the last 33 years, I'll come to that in a minute. But for that period from 1940s, which excludes the 30s, which was a terrible decade as well. But if you take that 33 years, nobody bought balanced funds, nobody invested in the stock market just because it was there the way they do now. Instead, what you had to do was pick stocks. And this is why books like The Intelligent Investor became famous, because you had to do better than average, and the only way you could do that was to learn a formula for how to pick stocks. And The Intelligent Investor provided that formula, and that's why it became famous, because it helped you pick stocks. And then if we look at the last 33 years, of course, what happened was the debt boom started. People started borrowing money to speculate in assets. For 33 years, the market went up 11.7% per annum. And yes, I picked my dates for effect and that sort of thing. And if I cut the rally up to 2007 out, it would look different. But basically, people started to speculate, borrow money to speculate. And we now have a finance industry which is telling you, or hoping dearly, that that is going to persist forever into the future. And it's that 33 years of debt boom on which all the averages are based and all the marketing in the finance industry is based. But the truth of the matter is I think people have wised up. If that debt boom doesn't come back, if we don't get irrationally exuberant and start borrowing money hand over fist again, the market could well start to do what it did in the prior 33 years, which is go up 2.9% per annum again, which is probably more normal. So my first suggestion to you is that in order to make money in the market, you can't rely on the market doing what it did in the debt boom. The next 10 years could be something significantly different, in which case it comes down to buying stocks.